We got numbers today on the U.S. economy, and it grew faster than previously thought in the second quarter. Now, some of that was because of a decline in imports, but there was also a pickup in consumer spending. We are joined by Olu Sonola, U.S. Head of Economic Research at Fitch Ratings. Thanks very much for coming on the show.
Thanks for having me.
What jumped out for you with this economic report?
The first thing that jumped out at me was just the upward revision on the consumer spending side. It was a full percentage point. And the narrative coming in was we were in the middle of an economic slowdown, and consumer spending was actually slowing a lot more than expected. So the fact that that was revised up changes the narrative just a little bit in terms of how you view the U.S. economy.
Sorry, Olu, you go on, please. Sorry.
No, it just demonstrates that it's quite a resilient economic backdrop. And if policy issues are taken out of the picture, probably will continue in that regard.
I guess the word trade distortions, that's tough for you and other observers, people accelerating imports, for example, to get ahead of tariffs.
Yeah, during the first quarter, we saw all of that acceleration. And during the second quarter, there was a lot of payback, or maybe I should even use the word give back. Mm-hmm. So it's not surprise. I think the way I look at those numbers are basically looking at the first half as a whole. And if you look at the first half as a whole, what you're seeing is 2+% growth for US GDP. That's not bad. That's actually quite a good place to be. The only worry at this time now is, okay, it seems like it's more or less a jobless growth environment. What's going to happen to the labor market going forward? Does this mean that we'll see a pickup in the labor market in terms of hiring, or does it mean that jobless growth is what we're likely to see going forward?
Wow, why would you get jobless growth? AI already displacing workers?
I think you can't ignore that fact. I also think immigration is playing a big role. Immigration is down big. And when you're seeing that decline in supply, it's also quite expected that you will likely see the decline in demand. And there are quite a number of industries that rely quite a bit on immigrant labor. Mm-hmm. And you're actually seeing contractions in those industries too. So it's a mix of demand slowing, and it's also supply slowing significantly.
We have been seeing pretty strong corporate investing, and you say a part of that, of course, is the massive spend on AI and data centers.
Yeah, without question, that has been a bright spot. And I was doing some math earlier, and I'm saying, okay, it's about 40% of total growth came from that investment in software and investment in information equipment. So if that continues, that provides additional support for the U.S. economy. And if you're listening to the press and you're hearing all the announcements by all these companies, it looks like that pace is going to continue and potentially accelerate. That bodes very, very well for the U.S. economy going forward.
It's interesting, though, you mentioned the jobless recovery. I guess these data centers, they don't employ very many people, a couple of security guards, a few technicians.
Yeah, it's capital intensive, and they just don't. It's all switches and basically switches and all whatnot in terms of electronics that it's filled with. So from a labor market standpoint, probably not the best in terms of juicing up employment, but purely from an investment standpoint, very, very good for growth and very, very good for the economy.
Will this stronger than expected GDP report change the Fed's mind in any way?
I don't think so. I think they're more focused on employment than they are on growth. And they will tell you they have two mandates. One is inflation, the other is employment. And then core mandate variables are PCE, core PCE, and the unemployment rate. They do pay attention to growth, but it's not a key driver of their decision. The general understanding is if growth is good, the labor market will be good. And that's why it's often quite a conundrum when you see job growth slow while economic growth is basically hanging in there.
I just keep thinking about this jobless recovery. I mean, that has social implications if it continues. People just can't find work.
It does. And what you're seeing is the weakness is really at that younger cohort level. And they're the ones coming in. It gets to that whole notion of low hire, low fire environment. If you have a job, you're fine. You're quite unlikely to be fired. But if you don't have a job and you have to look for one, it's very, very difficult to get a job. And if the investments that are being made are not really labor intensive, then that makes it even more difficult. And when you actually look at the technology is all about AI. And we know that to a certain degree, we'll see some displacements here and there. So it's still hard to nail down what the key driver is, but I think AI is certainly in the picture.
Olu, thank you very much indeed.
Thank you for having me.
Olu Sonola, U.S. Head of Economic Research at Fitch Ratings.